one of the cores of being successful investing is this concept of financial diversity and also the risk that's involved with it, or the benefit or the protection of risk as well. So let's talk about this whole aspect. Diversity is about spreading your investments across different asset classes, industries, geographic regions. It reduces your overall risk. Not one asset class or investment is likely to perform the same way all the time. You may love the technology industry. It is cool, it is exciting, it changes how we live a lot of times, except for the fact that sometimes sometimes economically, there's huge impacts, and all of a sudden the whole industry of technology plunges deeply or rises quickly. It just depends upon what's going on, what the world climate's like, what the economic situation is like, or whether or not the FTC decides to sue another different technology company. So it just depends exactly where we're at in it. So be cautious about putting all your eggs in one basket, so to speak, because that one basket, you might drop it and all the eggs crack up and you'll be shell-shocked. Yeah, it's a little bit of a pun. Anyway, so that said, let's look at the mix of stocks, bonds, and real estate and cash and see some of the things that we can do about reducing the risk overall. If one asset class performs poorly, others may do well or just good to offset those losses, and you'll be neutral financially. That's kind of what the idea of diversification is. It enhances your returns, enhances over the long period of time by investing in a variety sets of different types of classes, geographic territories, or whichever way you want to diversify your investment. It's a big deal. Here's an example. Growth investing focuses on investing in companies that are expected to grow at the above average rate. A lot of times, these companies don't pay dividends. They retain their earnings and plug back into the company, but the obvious part of it is that their stock prices overall increase. Some of them even have stock splits that make it even more valuable in the process. So growth stocks, they're more volatile than other types of stock, but they also have the potential to generate higher returns. The price you pay, the more risky it is, the higher the overall rate is going to probably be long term. But vice versa, the more risky it is, the more likely it is to plunge quicker than other types of stock. So then you may want to balance that out with some value investing, where you're really looking at companies based upon their intrinsic value, that they're undervalued by the entire market. So you may pick up one, and that might be a slow mover. It might pay dividends on a regular basis to kind of offset this one over here that doesn't, but grows faster. So you start doing value investing to balance out your growth investing. Income investing, you focus on assets that really generate income. Bonds are guaranteed to give you a type of return unless they go belly up. Anyhow, dividends, rental income. You may buy an apartment complex or buy a share into an apartment complex, get something back. A lot of income investors, they're less concerned about the capital appreciation and more focused on a steady stream of income on a regular basis. That is a huge part of the aspect of income investing. And that way you have a stream of money that you can live off of on a regular basis. Index investing, instead of you fighting, trying to figure out what to do, got program trading and everything else out there, just buy stuff in the index. Overall, a lot of the index, if you look at them, they will sit down and appreciate in value over time. And the S&P 500 probably is the biggest example of that. So index investing is low cost. It's a passive strategy. You don't have to watch it every single day. And it's out there. It's easy to see. You can always hear the Dow Jones Industrial today, change this, or the S&P 500 is, and you'll hear it easily through whatever medium you have. But the reality is paying attention to the overall index investing gives you a broad portfolio, especially if it's a mutual fund, ETF, whichever way you want to go. Different asset classes, stocks, bonds, cash equivalents, real estate, commodities, alternative investment. Those really are separate asset classes, we call them. So it depends what you have. If you start adding things that you have all in here together, this could be a really balanced portfolio. There's 11 different industries, but here are the 5 that we always look at: technology, healthcare, consumer staples, financials, industrials. Start diversifying in these areas, and that way the technology may go up or down, healthcare may go up or down, but the consumer staples, you'll have that, hopefully, unless there's an economic problem, on a regular basis. So pay attention to the different industries, different geographic regions. There's a lot of them. I just put 4 up over here: the US, Europe, Asia, emerging markets. I like emerging markets on a regular basis, especially in the mutual fund area. For me, that's where I actually have a part of my funding, but that's a choice for you. So pay attention to the different aspects of where you're going to invest geographically as well. Index funds, they're such a great way to get a diversified basket of stocks at a low cost. Different kinds of risk. You have the market risk, you have the credit risk, you have the liability risk. Well, that's what investing is all about. That's why you're getting a return, because you're taking a risk of some type. And the market risk is a visual representation of the whole market volatility. And the credit risk, you got to pay attention to that risk aspect. If you're buying C-class bonds, those are junk bonds, and you know what? The return is fabulous if you get your money back someday. Liquidity risk, discussing the importance of liquidity, how fast a company can actually sell its assets. It depends on the industry. It'll change. All 3 of these factors will change depending upon which one of the industries that you're investing in, or the geography of it, or this is all about you diversifying and taking the risk out there and seeing what's there. Here's a couple of graphs to look at. A graph like this is always a 2-dimensional representation of profit and loss possibilities. But you know what? You can create graphs all day long. At the end of the day, it really comes down to how much money you get out of the investment and how much increases your portfolio. The horizontal axis shows the price of the underlying security, and these graphs over here, and the vertical shows the potential profit or loss. You'll sit down and hope that you have this continuous stream of things going up. Yes, you too can be a champion investor. But you could also sit down and have all kinds of different risks, and you don't know what happens. You may have another pandemic magically appear, and everybody has to run around, wear masks and get shots. Yes. But they may change a matter of one of the person changes offices, and all of a sudden that changes. So who knows what the future holds for us? Stocks are often considered riskier than bonds, but they have potential to get higher returns over the long term, where bonds tend to be safer than stocks, and they tend to generate lower returns. And you know, a lot of times the cycle is one goes up, one goes down, except for the fact we've seen recently they both go up at the same time, and doesn't make any sense because the economy sometimes doesn't make any sense. Pay attention to the risk, but bonds are considered far safer than stocks because they don't have as much volatility, but they also don't have as much volatility, which means they don't change price as much as stocks will. This is the perfect risk-return trade-off. It's nothing but a straight line up. Yes, that would be ideal. This is another risk-return trade-off, the efficient frontier. Yes, you're out there earning money on a regular basis, but this is reality. Okay, you have this crazy jagged line, those pretty little graphs of things how you plan. I have my strategy, and this is what I plan on doing with it, and I'm going to make a lot of money. Yes, and you could be down over there, buy a bunch of crypto. Oh yeah, that'll work really good for you. Crypto is all risk. There's nothing intelligent about the crypto market except for the fact that if you put a lot of money in, you may have a lot of money more tomorrow, or you may have no money tomorrow. That's the only thing for certain on crypto. But you'll see over here, you got the S&P 500, emerging markets. You'll see some waves, but you also need to see one plunge and one goes up. That's why if you invested in the S&P 500 and emerging markets, there's merit to that, because as one goes up, you can sit down and increase your return on the other one to make certain that the overall balance will be really good in your portfolio. So pay attention on the different aspects of what the graphs say, but also as to where they're going, although you really don't know, except for the fact sometimes you may do better than a computer because you're going by your instinct or your gut instinct in the process. Sometimes it actually works. There's no guarantee about risk, no guarantee about higher returns because I bought this, no guarantee that bonds are safer today because the whole thing may change. On a general rule of thumb, investors that take on more risk have the potential to generate higher returns over the long term, but you have to wait. And sometimes your stock, your bonds, your ETFs, your whatever you have may plunge. And sometimes you just can't panic. You have to let it ride. And it may take 3 or 4 years to bring back to where it was, but then it may skyrocket. There is no intelligent way of investing and knowing all the facts ahead of time. If you did, if I did, I probably wouldn't be teaching this class and you wouldn't be taking it because we both already know, well, what happened. Low risk investments, government bonds, we'll talk about that in a bit. Money market funds, CDs, those are super low interest rates. A government bond is safe unless the whole government falls apart, and then there won't be any banks anyway. So what difference does it make? So you have the whole aspect. These are super safe, but they don't pay very much. Medium risk corporate bonds, they tend to be safe if you invest in a good corporation, especially an A, double A, or triple A. Dividend stocks, real estate investment trust, and then the high risk small cap stocks, small capitalization stocks, emerging market stocks, venture capital. In conclusion, diversity is the important part of the risk management. It reduces your risk by spreading your investments across multiple different asset classes, industry, geographic regions. Overall, by having a diverse portfolio, you can reduce your risk and improve the chances of meeting your financial goals. Now, that said, how do you do that with a little bit of money? Probably the best way to have and increase your diversity is buy small shares in a vast amount of mutual funds, and that we can diversify quickly with a small amount of money. And then as you build it up, you get more specific as you go through. But however you do it, it's up to your choice, because that's what free markets are all about. Take care.